Well, once again, good morning, everyone, and welcome to the weekly life webinar from the Messer Financial offices here just outside of Charlotte, North Carolina. And as always, what we intend to do today is add to your arsenal as agents enough information on a product so you can go out there confidently, present it to your clients, and create the kind of business that we're all looking to achieve. Just a couple of housekeeping items this morning before we get started. Of course, I want to make sure your phones are muted. System does have you muted, but occasionally something might slip through. I also want to let you know we're going to hold our questions until the end. That will allow our presenter to move smoothly through the presentation, and then we can come back and answer those questions. Sometimes they get answered actually during the presentation because you get a little ahead of yourself. So we'll do that. We'll also ask you to stay with us until the end so we can do a little product review and announce any type of bonuses we may be able to make available to you on the first piece of business that becomes available. So with all that in mind, again this morning, I'm glad to welcome once again Mr. Chad Canese. Chad is with OxfordLife Insurance, and he's out of Indianapolis, Indiana, actually. He's their regional director and assistant VP, and he's been at this annuities business for about 20 years. So you can understand that he'll be speaking with great confidence in the products that he'll be presented. Good morning, Chad.
Good morning, Mark. Yeah, thank you very much. Thanks for the invite and the opportunity to come in. We'll go ahead and get started. I think, and hopefully everybody's got a copy of my screen right now. Oxford Life Annuities. So I'll go ahead and get started first off with my contact information. Again, I'm Chad Canese, as Mark mentioned, the Eastern Regional for Oxford Life, but I'll start out by saying it doesn't matter if anybody's up early, you're out on the West Coast, wherever you might be. Call me with any questions. Feel free to just let me know anything at all I can do for you. We're really not that hung up on territory at Oxford Life. So again, wherever you might be listening in today, please just contact me or anyone with Oxford on questions or whatever we can do for you. But that is my contact information. You can reach me directly at 866-626-7532 or my mobile number. That's a 317 area code. As Mark mentioned, I'm located in an office here we have in Indianapolis, Indiana, and there's my email address. Now, I figured with today's webinar, first maybe introduce everybody a little bit more Oxford Life in the event that you're not familiar with us, haven't used us, or maybe just haven't looked our way as of yet. And then we'll jump specifically into some of the annuity products that we offer, and as Mark mentioned, kind of come back and wrap up with any questions, anything I might have missed. So first off, for those of you not familiar with Oxford Life, we're a leading provider of really senior-oriented products. Life insurance, which would be single premium life as well as final expense. I'll squeeze in just quick commercials here, but our final expense, if anybody knows Oxford Life, it's probably most typically for the final expense product. We always have some of the most competitive rate out there, guaranteed point of sale decision, quick, easy issue, 48 hours turned around and commissions paid. In addition, we offer Medicare supplements. We have a number of different products, or plans I should say, available. Our Plan G coming out here shortly, so keep an eye out for that. We have now filed it and expect our Plan G to be available in the majority of states here in about the next probably 30 to 45 days. And then, of course, annuities. We do annuities, fixed index, as well as multi-year guarantees that we'll spend time on here today. Oxford Life, we're founded in Arizona in 1965, and we still remain domiciled and based there today. Actually, we're in Phoenix, Arizona. And again, as the bottom line there says, really a senior-oriented company, products that help seniors live with dignity during those retirement years. Now, as far as Oxford Life and our corporate structure, this is always a fun slide, even for those people maybe that have been appointed with us for a number of years. Sometimes don't even know where we fit as far as our corporate structure. We're owned by Amerco, A-M-E-R-C-O. And I always like to spell it because inevitably people like to drop another vowel right there in the middle, another carrier and insurance company, but we have no affiliation. Really, Amerco is just a holding company. They They own OxfordLife, North American, Christian Fidelity, Dallas General, a few other insurance subsidiaries. Most all of our products are written through and written on OxfordLife paper, or through OxfordLife, if you will. Now, over on the right-hand side of your screen, that is U-Haul, as in U-Haul Moving and Storage. And I know it's an interesting fit, moving and storage company along with a bunch of insurance companies. But it does have a number of advantages. One of them, it's kind of that brick and mortar feel. Maybe you or your clients don't know the OxfordLife name, but I'm willing to bet, as 90+% of America does, know the U-Haul name. They've rented one of the trucks, they've seen the storage unit on the side of the street, whatever it might be. So again, it does help create some of that familiarity. In addition, from a kind of a personal standpoint, we have a lot of shared resources. Out in Phoenix, you have the U-Haul buildings on the front of the street, and then OxfordLife operates right behind it. So we have a lot of shared human resources, legal departments, and everything else with U-Haul that really are advantageous to us. In addition, if you've ever ordered OxfordLife supplies, you're going to notice that they come to you in a U-Haul box. We ship all of our materials from a U-Haul facility in the Midwest. And then finally, if you or your clients ever do want more specific information on OxfordLife, we are publicly traded. We trade under the U-Haul symbol, UHAL. So you and your clients can always go out there and grab additional information, financials, whatever it is you might want or anything you might need. Now, if we're just to kind of pull OxfordLife out of there for a moment and just look at our financial strength as a company, we have been recognized by a few different third-party groups for our financial strength, most notable AM Best. We are A-, excellent rating with AM Best, and just recently reaffirmed at that A-. And probably one of the big reasons, we're not the biggest company out there. We're about 1.7, 1.8 billion in total assets, but we are a fairly cash-rich company. Our best capital adequacy ratio, it's more than twice the AM Best requirement for any A++ rated insurer, and it has been for every year over the past 5 years. So it's not like we just hit that figure and said, wow, that looks great, and threw it up, but we've actually, the requirement for an A++ rated carrier is 175% on your BCAR, or the capital adequacy ratio, which basically is a reference to your liquidity. We've been at or above that level again every year for the past 5. To put that into better perspective, we've got a nice piece, some different financial pieces you can share with your clients. One of the more notable is the Standard Analytical Report. Everybody might be familiar with that one, but it typically says, for every $100 in liabilities, this carrier has this much in assets. And the leading 25 insurance companies in the country have about $105, $106 on hand for every $100 in liabilities. OxfordLife, we're about $116, almost $117, so well above the industry average. So whenever you're considering doing business with OxfordLife, or you are doing business with us, thank you very much. Hopefully financial strength is one of those reasons. In addition, unique competitive products. We do offer top-level commissions, superior producer and customer service. I think that's always one of those things you prove more than you just say or you talk about, and hopefully we've had the chance to do that, or we get the chance to here in the future. We do training webinars, individualized services. We can personalize a number of different marketing materials for you, specific to the annuities, different maybe newspaper ads, anything like that for the product, flyers, whatever it might be. We've got a number of items like that you can select from. And then underwriting support, that would be more specific to our life products, but I will point out that if you've appointed with OxfordLife for our life products, you have access to the annuities and vice versa. It's just one contract for any and everything that we do. So if you're looking to us for one area, those life products, and you've got the underwriting support, keep in mind you can write our annuity products as well without any additional contracting. Now I'm going to go ahead and we'll get started on, I guess it's fair to say that we've really got two different products at OxfordLife. So it's a very straightforward, very simple product portfolio when it comes to the annuity. But you do get a lot of options, starting with the multi-year guarantee. It's called the Multi-Select, and what this is, it really is just your CD alternative, and those are the clients you want to think of with this product. It's simple, it's straightforward, but most importantly, it's guaranteed. And even in this interest rate environment, and I think Mark and I were talking here a little bit earlier, it's low interest rates have kind of become the new norm. So we've found that clients are very content just to come in and lock up, even though interest rates aren't what they used to be. Clients are still quite pleased to just get guaranteed growth, especially in this environment. And we'll review some of those rates in a bit, but as an example, our 5-year right now, it's 2.45%. That is certainly one of the best rates out there on a 5-year product right now, especially whenever you consider it's coming from an A- carrier. Now, I've already kind of talked a little bit about, I guess, some of the opportunities with it, but again, Multi-Select, it's there for guaranteed growth. Clients that interest rates, they're looking for just a guaranteed period, and you elect that period at policy issue. Now, the Multi-Select offers durations 3 through 10 years, which is really nice. You can be in and out as quick as 3 years. I like this 3-year rate. I'm going to pick up, I'm going to get out, I'm going to see if things have changed, I'm going to see if things are better. You can go all the way out to a 10-year duration. And needless to say, the longer duration, the better the rate. So you do have, again, these 3 through 10-year periods that you can elect from on the product. Now, with all of those durations, the 3 through 10 year, 3, 4, 5, 6, 7, 8, 9, and 10, you have a 30-day window at the policy anniversary. So your client is going to get notification 30 days prior to their anniversary date with some election options. The owner can decide to do any combination of these 3. They could, option 1, decide to renew the contract for the same guarantee period, and the contract earns that new stated interest rate. So example, I mentioned the 5-year option. We're going to guarantee right now 2.45 for the next 5 years. 5 years from now, or 4 years and about what, I guess 11 months, the client is going to earn that 2.45. Then they're going to get a notice that says, hey, here's the rate for the new 5-year period. If you'd like to stay, that's your option. Option 2 says they can decide to annuitize that contract for a minimum period of time, typically 10 years or maybe a life with period certain option. That's going to be available to them as well. Or option 3, the client can just simply decide to pick up, withdraw all or a portion of those funds without any kind of a surrender charge or any market value adjustment. So again, the product is completely liquid for that window following the 5-year term, no matter what term you've elected, again, 3 through 10 years. Now, surrender charges for this product, a surrender charge does apply to withdrawal amounts that are greater than the penalty-free amount. Each guarantee period has its own surrender charge schedule, but they all begin at 10%. So you're looking at that schedule here right now. It's also included in our product brochure. But again, whichever period you've elected, it's 10.98, declining from that point. Now, along the way, your client does have access to funds and withdraw money. And I will stress this part because I think it still keeps us rather unique. These features are automatically included into the product. There's no additional charge for it. It doesn't reduce your rate. There's no additional cost to the client. You get a 10% penalty free after the first contract year, and that's 10% of the account value. Anytime during the contract, you can elect an interest option, and again, that can start as early as 30 days into the policy. So clients that are looking for that monthly income stream, again, a guaranteed income, this is a great opportunity, a great alternative for it. You can elect that again straight out of the gate, day 1 of the contract, and pick up that interest check 30 days from now. In addition, we make, and I'm going to highlight these now because these are the exact same riders that are included into our indexed annuities that we'll talk about. But we also include waiver of surrender or withdrawal charges, things like a terminal illness benefit. If you're diagnosed as terminally ill, basically 1 year after the policy has been enforced, you can access the full account value, no penalties, no charges, no market value adjustment, full account value. Same thing with home health care. If after the first contract year and you are receiving home health care and have been at least for 90 consecutive days, the previous 90 days, you get the full value. And then same thing for nursing home benefit. If it's after the first year, you've been there for 90 consecutive days, full account value, full access to the funds, which I think most people will agree it's pretty liberal, it's a very fair schedule, and again, no additional cost for it. Automatically included in the states where it's approved. Now, I'll go ahead and talk a little bit about market value adjustment. It's the definition, I guess I'll just say that it's there on your screen. And the best way to describe or remember a market value adjustment, it's an inverse relationship with interest rates. If interest rates are going up, you're going to have a negative MVA. Conversely, if interest rates are going down, you're in a declining interest rate environment, it can have a positive effect on the market value adjustment. It means that the client's surrender charge might be dampened by an increasing market value adjustment. It's basically just an insurance company's way to help protect on the deposit we made with the client's funds. Now, the other thing to keep in mind with a market value adjustment, and probably the most important, it only applies, or at least it only applies on our product, if the client surrenders the contract prematurely or they exceed more than their 10% penalty free. If they stay within the confines of the contract, the market value adjustment does not apply, whether it's positive or negative. Now, the minimum and maximum issue amounts for this product, you can start multi-select with as little as $20,000, and that's qualified and non-qualified funds. We go up to a maximum of $350,000. And I will tell you, we do not make exception for that. I know it's a rather low maximum premium, but there's reasons for it. A big reason is that it helps us maintain a consistent rate throughout the course of the year. We don't get a bunch of $1 million tickets and say, wow, that was a lot of business this month, we need to lower the rate. Our idea is to be a consistent multi-year guarantee rate for both you and your clients. So anytime you think multi-year guarantee, you think OxfordLife, and you know we're going to be some of the most competitive rate out there. Now, the product availability, we go ages 18 up through 80. Now, this chart kind of breaks that down a little bit more in detail. We do have some restriction on older issue ages. Again, 80 is our max. And at age 80, you can write a 7-year duration. The 8, 9, and 10 are kind of off limits, as you might see there on the screen. So again, we do limit some of the longer durations on older issue ages. But you can write this product up to and including age 80, depending upon the duration you want. Now, here are some of the state approvals. Go ahead and check out the website for these. Call us for any specifics. The things I'll really point out, there's just those handful of states in which we don't do business: Montana, Mississippi, Alabama, West Virginia, New York, Vermont. Sorry if anybody listening in from there. Again, those are states where we just don't do business. We have no products approved. The others, there's just going to be some of those state modifications, maybe from the application, maybe some of those withdrawal riders that I mentioned. The nursing home and terminals can have some variations, or maybe they're not approved. So check with us for some of those specifics. But the product really is just about identical as far as the rate from one state to the next. Now, that pretty much wraps up the multi-year guarantee product and presentation. Again, it's a multi-year guarantee. It's pretty straightforward. What you see is what you get. 3 through 10-year durations, and what you get is a very competitive rate. So again, keep us in mind for those and clients that are looking for those guarantees, kind of that CD alternative, if you will. But now we're going to pivot to the Select series, and this is OxfordLife's fixed indexed annuity product. And we stay along the lines of simplicity here. We've got 3 different versions of an indexed annuity, but really they're all built on the exact same chassis. They're all the same duration. They all have the same crediting features. It's just some variations as far as bonus and cap opportunities. And we'll jump into those. But before we do, we use the next few slides to kind of remind, I guess, about a fixed indexed annuity. It offers the opportunity to benefit from the increase of the stock market without the downside risk. And I know we know that, It's been the mantra, I guess, if you will, for indexed annuities for what, the past 20 years. Upside potential, protection from the downside risk. But, I think it's like a lot of things. Whenever we know it, we sometimes tend to relay it and kind of reassure our clients. And we have a slide that's put together here, and this slide's always much more fun whenever we're in a room together. We're still going to go through it just for the power of that statement. Again, the upside potential, but most importantly, avoiding the downside risk. Because for a while, indexed annuities, we got caught up in the upside potential, and now I think more than ever we're kind of caught up in the income opportunities with indexed annuities. But it really is still about, kind of the old zero is the hero. So let's take an example of it. Let's say that Grandpa, and I'm sorry, I keep clearing my throat here on everybody. Grandpa put $100,000 into the S&P back in 1928. And back then we had an S&P right around 24.35. That's right, 24.35. Now, Grandpa put in $100,000 and basically just said, let it ride. And I want to stress right now, this is not a clear illustration of an indexed annuity by any means. We're not going to take into account participation rate, cap, spreads, anything like that. We're just looking at a pure example of the index. And over the course of the next 76 years, we had 50, if you're to count those up, times in which the S&P was positive. Some cases a little, in some cases a whole lot. But right there on the screen, you've got 50 green bars where the S&P was positive. So conversely, that means 26 in which the S&P was negative. Again, some a little, some a lot. But over that 76 years, that $100,000 deposit would have returned $5.8 million. So not a bad return over a 76-year period. Just had Grandpa put $100,000 into the S&P for us and said, let it go. But now, let's take an example of this same chart if we're to eliminate any and all of the red. Remember, said 26 red on the screen. And let's just replace red with a 0. Now, the power of, again, eliminating downside from the market, that same $100,000 deposit would equal, and this is always fun where to quiz everybody, if you're able to read tiny print you see down there on the right-hand side, that same $100,000 would equal $461 million, just simply by eliminating the negative from the market. And again, I'm going to stress that's not an indexed annuity illustration. We didn't say, caps of 3% or participation rate of 35 or whatever it might be, spreads of X. But that is still a very powerful story by taking the negative out of the market. And everybody always says, well, you started in 1928, years right before the crash, where you can see there the S&P went from 24 to around 6. But sometimes we'll always remind everybody, but isn't that the point? We don't know. A lot of people like to think they do, but when that next period is going to be, when that next crash, when that next drop out of the bottom is going to happen. So, and that's the benefit of the indexed annuity. It's the upside potential, but just as important, it's that downside protection. And that's really what has made indexed annuity so popular over their history. So let's move on to some of the product specifics, and let's talk about wealth accumulation strategies. I mentioned we've got 3 different versions of this product, but all of them share these same different account strategies. You can elect a fixed account, which is pretty straightforward, pretty simple. That's just a fixed interest rate guaranteed for the policy year, and then we reset that each policy year. So again, you come in today and it's guaranteed, 2.1% for the next year. We'll reset it next year. We do a monthly average strategy, and again, this is the kind of good old monthly average. It's not a monthly sum. It's not a monthly point-to-point. It's a monthly average where we take your starting point on the S&P today. We're going to take the next 12 consecutive months, or I guess 11 consecutive months, we're going to come up with an index average based on that date. We're going to compare it back to the starting point, where we then apply a cap and we credit that amount back to the contract. So pretty straightforward. One of the longer standing strategies out there, and again, we do this based on the S&P 500, and we have an annual reset, annual credit gain each and every year. Same thing with the point-to-point. It's S&P based. It's a little simpler. We're just going to take those 2 dates in time. You come in today, the S&P is at 2100. That's your starting point. We look to July 20th of 2017 for your ending point. We compare the percentage difference between those two. We apply the cap. We lock that gain into the contract. So again, pretty straightforward, pretty simple. You can mix and match among these strategies however you'd want, as long as it's equal to 100%, third, a third, a third, 50-50, 100% in one, doesn't matter, however you want to do it. You can also reallocate on an annual basis. So we see a lot of clients doing that. We see a lot of clients doing kind of 50-50 between the monthly average and the point-to-point strategies. But the most important part, you cannot lose any previously credited interest. Just like any indexed annuity out there, once you get a gain, you keep it. You lock it in and it's guaranteed. Now with this product, pretty similar. You do have a very friendly surrender charge schedule. It's 10.98 declining over the course of the 10-year period, and it is again a true 10-year product. And along the way, you get access to the funds. You get the 10% penalty-free of the account value, 10% of the account value after the first contract year. And then for any options, I've mentioned already that we've got a couple versions of this that have a bonus. We do a vesting percentage on the bonus option. So call it vesting, call it recapture, but really works the same. If we apply a bonus up front, that bonus is applied day one on the contract, but the thing to remember, if the client leaves early, we're going to recapture a percentage of that bonus. They're vesting along the duration of that contract. So at the end of the 10-year period, the bonus is 100% vested. Again, they can pick up, they can walk away, do whatever they want with it. They've earned the full bonus. And really, that's just protecting, I guess, everybody from what were some of those gaudy surrender charges, if you remember them from years back. Again, this thing nice and clean, 10% declining surrender charge schedule. If you remember, some of those products with 5, 6, 10% bonuses would have 19 and 20 plus surrender charges. Well, that's because if you've got a big bonus, you need to protect yourself in getting it back. So what we do is just the vesting or the recapture. But again, I will stress that our bonuses are applied up front day one for any kind of crediting purpose. Now, similar liquidity features, already mentioned the 10%, get that after the first contract year. You can do an interest option on this one as well if you're allocated to the fixed account strategy. And then you do have those same features that we talked about earlier. Terminal illness, home health care, and nursing home rider are present on this product as well, where approved. And it's the same features. If you've been in the contract at least a year, those things apply for the full account value of the contract. Plus full account value including the bonus if you've elected one of the bonus versions. So important to remember there. And then we still have annuitization options. I know annuitization is less talked about today with the onset of the income riders, but you can annuitize this product as well for various period certain life options, life with period certain. Now, speaking of guaranteed lifetime benefits, this product does have one. It is available on all 3 versions of our indexed annuity, and it's quite competitive. What we do, we roll it up at 6.5% on an annual basis. So again, if you've elected the GLWB, keep in mind this is an electable feature. You don't have to choose it. The majority of clients that purchase our indexed annuity do, but again, it is strictly optional. If you do elect it, it's 100% of the initial deposit plus any premium bonus maybe that your client gets, and it's going to grow 6.5% on an annual basis, and that does compound and credit to the account on a daily basis. We do have an automatic step-up feature, so if at any point in time the account value should exceed the income account value, they get the greater of the two. Now, our cost for the rider is something that we're pretty proud of as well. For a 6.5% roll-up, it's only 75 basis points, and that's charged against and deducted from the accumulation value. A lot of them out there are going to charge it against the income account value, which, let's face it, 10 times out of 10 is going to be the higher value. So again, it does make this thing even more affordable as far as a cost, because really that's quite important. You know, it's not always just about the income that your clients get, but it's about what they're going to leave behind maybe to a beneficiary, or maybe what they're going to have available if they should choose to surrender this contract. So cost for the rider is definitely something that we need to kind of keep in mind and look at whenever digging through products. Now, the GLW, when GLW payments begin, they are based on the income account value on the client's then attained age. And here's our attained age chart. We start at age 50. So you can trigger this income rider anytime after age 50 and anytime after the first contract year. The payout option starts at 3%. It increases 50 basis points in every 5-year increment. So 55 to 59, it's 3.5, all the way up to 6% for your ages 80 and above. We do joint payout options as well. So for a husband and wife, if you elect joint payout, it's just a 50 basis point reduction. So pretty friendly there for your joint payout options as well. Now, I'm going to use this as an example for the indexed annuity. We don't do hypotheticals on the index performance, but you can illustrate the product over on the right-hand side with the guaranteed lifetime withdrawal benefit. And the reason is that's guaranteed. We know those figures. They're not going to change. We know everything about that right-hand side. But we wanted to at least put up here an example of the hypothetical, just to remind you that if you elect, let's say the Royal Select as we have here, that is our 8% bonus option. And the reason we want to stress this, it's to show you that you put in a $100,000 deposit, you get that 8% bonus applied up front. It's there day one of the contract. So that means you've got $108,000 in your account value, receiving and getting any type of growth, any type of interest earned. Let's say you've got a 3% cap in the S&P option. So again, that means we're going to credit 3% right on top of $108,000. You've got $111,240 in your account value after the first contract year. Again, that's guaranteed. It can't go down. We've locked that amount in. We reset for the next year, so on and so forth. So, and that kind of runs you through those examples over the course of the next 10-year period. So that's really, I guess, what we're looking to kind of stress and remind everybody there. Now, on the right-hand side, that is the guaranteed lifetime withdrawal benefit. That's the optional feature. But we also apply the 8% bonus to the income account. So again, you've got $100,000. We apply 8%, so you've got $100 day one in the income account. And now we're going to grow it at 6.5% on an annual basis. So you can see after the first year, your income account, your client has $115,000 in there. So now we're back to looking at that statement at the end of the first contract year. Your client gets it in the mail and they say, I'm ready to flip on, turn on my income. So we're going to look at those two values, the account value at 111 or the income account value at 115,000. We're going to give them the greater of the two, and we're now going to apply that attained age factor. Let's say they're age 70, that means they're at a 5% factor. So we're going to give them 5% of the $115,000 in a guaranteed lifetime income forever, or as long as the contract remains in force. So they can elect that on a monthly, quarterly, annual basis, however they might want to receive it. But again, that is a guaranteed lifetime income, even if that account value side goes to zero. They continue to get guaranteed lifetime income. And should the client ever want to pick up, walk away, they can do it. They're going to get that remaining account value from the contract. Now, different sales requirements for this product, just to review, it does have its own specific application. It does have its own disclosure form for the income rider because, again, remember, this is an optional feature, so we do have a separate disclosure form for the income feature. Suitability, 1035 forms, all the standard stuff, life and replacement forms, we've got delivery receipts, and then other forms for other requirements, things like POA, trust documents, all that kind of stuff. Now, the product features, we do ages 18 up to, again, a maximum of age 80. But I will stress something here. The product goes up to age 80. Something you want to keep in mind, and I consider it a fairly sweet spot. You can write up to and including age 80, and there is no reduction on our bonus. I've already kind of let the cat out of the bag, but the Royal Select, it's an 8% bonus. So again, you get a 10-year product with a true 8% bonus, that all the way up to age 80. And again, it's full account value at death. It's full account value if you trigger or trip any of the nursing home, terminal illness benefits, and any of those things as well. So again, very friendly features for that bonus all the way up to and including age 80. Issue amounts, we dip a little bit on this one. We will go down to 10,000. That's for both qualified and non, but still that same maximum 350,000 as far as the max premiums. The death benefit, it is full account value upon death of the owner annuitant. So again, it's full account value. If you've elected the bonus option, you get the full bonus included to that upon death of owner annuitant. Now this product does also have a market value adjustment in the majority of states. We'll see here on a map in a moment. There are some states where the product was approved without or only approved without the MVA. But just like the multi-select, MVA only applies if the contract is surrendered early or your client takes more than the 10% penalty free. And then similar, we've already covered, but the guaranteed lifetime withdrawal benefit, 6.5%. It grows for the first 10 years of the contract at that 6.5%. It's an annual fee of 75 basis points. It must be added at policy issue. You can cancel it at any time, but it must be added at policy issue, and you can turn it on anytime after age 50 and after the first contract year. Now, the Select series, they're all single premium fixed deferred annuities. They all offer the guaranteed lifetime withdrawal benefit rider. They all have those waiver of withdrawal rider features where available, where approved. The same 10-year surrender charge schedule, that 1098 declining surrender charge schedule. And then all three the same crediting strategies, the fixed account, the point-to-point, and the monthly average. And similar in all of them as well, you cannot lose any previously credited interest rate or credit. Now here's where they're going to be different. And this really is the best way to differentiate. The Royal Select is the best seller of the bunch, and maybe not shocking, it's because it offers an 8% premium bonus. It is one of the highest bonuses offered, period, out there in the marketplace today, let alone whenever you're talking about doing it on a true 10-year product. Because again, this thing doesn't go, 14 years for the bonus to vest, anything like that. It is a true 10-year product, and the bonus is fully vested after the 10-year period. Also fully vested on death and those other issues we talked about. So that's what you get with the Royal Select. The Silver Select, it's a 4% premium bonus, but it gives you a little bit higher caps because we're giving a little bit less bonus. So again, it's a little bit of balance between bonus and better caps. Or you could go with the traditional Select. This product offers no bonus, but it offers some of the highest caps that we can provide. So again, it's really that trade-off, and what we found, it really makes for a nice kind of ABC presentation with your client. You might get a client that says, well, gosh, I want a bigger, better cap, or, so-and-so mentioned a higher cap than that. Well, let your client pick. If you want an upfront bonus, there is a cost for that. I guess nothing is free, and that is priced into the product. So you can maybe opt to go with a lesser bonus and a little higher cap with the Silver Select. Matter of fact, you could go with no bonus at all and get some of the best caps available in the traditional Select. So it does kind of work as a nice option or kind of opportunity to present it that way. And then all of them, again, will offer the guaranteed lifetime withdrawal benefit. 6.5%, guaranteed growth on each of those. If you know your client's going to elect and trigger this thing for income purpose, I will say, and you probably know, you probably figured it out, but the Royal Select is the best option, just simply because you're going to supercharge that income account day one with the 8% bonus. Now, here's some of our state approvals. This is the Royal Select and that 8%. Those gray states are, again, the ones where we're just not doing business. The teal, kind of greenish color there, those are the states where the MVA, it was approved without MVA. So those states, the product is identical, except there is no MVA, which means we had to change something, and it's the commission. So I shouldn't say the product's identical. The crediting methods, the income rider, all that stuff's identical, but you do take just a little bit of a reduction on commission in those non-MVA states. Similar with the Silver Select, this is the map. You can see, again, a few states there that are considered non-MVA, all those other states that are approved. Just check with us maybe for some of the specifics on those waiver of withdrawal charges and riders. If you see your state there in red, that means they're approved. That means they're good to go, just as we discussed them. And then finally, the Select. This product, you know what? This map needs to be updated. We've got a few additions here. Delaware and Virginia are now, in fact, approved. I'll make sure we get that done, but again, pretty similar as far as the state approvals and the features of the contract. Now, before we get into some of the question and answer, I'll just highlight a couple of other things. OxfordLife, I guess, like a lot. We're trying to develop a little bit more of a social media opportunity or presence. We're out there on Twitter, we're out there on LinkedIn, we're out there on Facebook. It's great ways to kind of stay in touch with us on changes, maybe updates to rates, things like that. So take advantage of them, check us out. And also want to point out that we've changed up a little bit this year as far as our incentive program. We've always done a trip in the past, just kind of our way of saying thank you for business. This year, something different for us. It started back on January 1st. It'll run through December 31st, so I know we're getting a little late, but maybe some of you out there do business with us. And again, keep in mind, all business counts towards it. Whether you write MedSup, annuity, final expense, single premium life, whatever it is, all your business counts towards this incentive. But if you wrote nothing but annuities with us, the qualification mark is 1.2 million. And you could write nothing but multi-year guarantee. There's no restriction on the product. You could write nothing but 3-year multi-year guarantee and still qualify for this incentive. But once you qualify, you pick what you get, what you want. We'll give you lead options. I say lead options. It's really just marketing reimbursement, seminar marketing, direct mail, whatever it is you do, whatever it is you want, we'll reimburse you for it up to a certain percentage. You can go on a trip where you want, when you want. We'll give you money towards that. Or we'll just give you straight money. You can qualify just for a straight cash reward. And this thing's very rewarding. It could be up to additional $10,000 a year in incentives that you could max out on with this. So again, a little bit different opportunity from us this year, but again, very rewarding. So just give it a look. If you have specific questions about us, let us know. Let us know how we can answer those, or again, anything else at OxfordLife. And I'm sure there's going to be some additional questions, probably some things I moved a little bit quickly through. So please, again, take down my contact information. So if anything I can help with, anything I can do for you at OxfordLife on any of the OxfordLife products, annuity or any of the others that I mentioned, just reach out to me or let me know how I can help, what I can do. And before maybe some of you do go, I want to say thank you again. Thanks, Mark. Thanks to Messer Financial for letting us come in here today. We appreciate our relationship, our partnership with you guys. And thanks to everybody out there doing business with us already. And thanks for the listening in.
Well, again, thank you very much, Chad, for getting aboard with us this morning and bringing to the agents a lot of information, especially for the agents who may be a little new to it and perhaps a little tentative to get involved with it because you're dealing with a lot of money sometimes for your clients. So, and that's okay. You want to be that safe. You want to think that way. That is your responsibility, and it'll come out when you have to complete your paperwork anyway and make sure you're doing things in proper order. Let's start, though, with the fact that most of you should know the Oxford name. If not, I think Chad has implanted in your thoughts, the places you can turn to with your clients to make sure they recognize it. I think it's also important that we look at the rating. And again, with a company like Oxford, the rating is a very good rating. And of course, those ratings are always based on the amount of dollars that the company has under management. So, a lot of times some of the companies that have the higher ratings just have a lot of money under management, but it doesn't necessarily mean, in my opinion, that they're a better company to work with. Let's look at some of the information that was provided to us today. And again, when we looked at the multi-select, just the simplicity for you to be able to say to your clients, where's that green money? Where's your safe money? And of course, with most of them, it's going to be a CD. So again, it's the multi-select product that's really going to be your alternative answer and a place for them to move it to. And of course, when they have a CD, currently today, the rates aren't the rates that you just saw guaranteed here in the presentation. They're much lower. And of course, also bear in mind that that CD isn't going to give them the benefit of the access for that terminal illness, that health condition, that home health care, because once you break that CD, bang, you break it. You've got the penalty to pay. So again, a wonderful benefit to look at. Then when we looked over at the Select series and we went into all the fixed index available options that you have there, knowing that you can work with just the basic reset annually, you can work with the monthly, or you can work with the annual point-to-point. And I know sometimes, especially when you're a new agent, that's all very confusing. Again, fall back on us. We're here to help. Chad would be more than pleased to pick up the phone and talk with you and help you through that type of a question. And also recognizing then too how that bonus works, that bonus is all up front. That's pretty important to understand, because I'll tell you, there's some products out there right now that offer a bonus. And let's just use an example. I can't say specifically where, but let's say they have a 10% bonus instead of the 8%. They probably are offering that bonus, though, on a 10-year product, 1% a year for the next 10 years. So again, you really got to look at where it's coming from and how it's coming down to you. Again, with the guaranteed life options, those are wonderful. I think more and more people are looking at that today, especially those that are managing their money towards retirement and looking at how poor the returns are. When you can come back and give them a benefit like that, looking at a 6.5% annual step up, all I can say, ladies and gentlemen, is that's very strong. That's a wonderful lifetime benefit withdrawal option that you have there. And then again, too, Chad, thank you very much at the end when you really broke it out for them to see on those 3 products, the Royal Select, and the reason that people might lean there more heavily because of that bonus. And again, on the Silver, that it's half of that. However, there's an increase in those caps. And then, of course, on just the basic Select, the bonus isn't there, but it gives them the option for the highest return. And again, I think your example was wonderful, just to say that, these are options that you have. So in case your client has heard or been offered something else, you can show them that alternative, but perhaps why one of these might be a better choice. MVA, always hard to understand. I think you did a great job on that, Chad. Again, thank you. And again, ladies and gentlemen, remember this has been recorded, so you can go back to the Messer website. You can go to our agent resources somewhere in the next 24 to 48 hours. You can pull this up again, and perhaps you just want to make a copy or steal and paste that page about an actual definition of an MVA and study it a little further so that you truly do feel comfortable with how that can affect the client's income stream, etc. Also, the fact that you've got bonuses available to the agents, again, lucrative, and giving agents the options of the type of bonuses that they'd like to look at. And speaking of bonuses, before we do depart today, What Messer will do, the greatest thing about annuity, and I kind of just lightly hit it when we opened up, it's a life product, but ladies and gentlemen, it's not a life product that your clients need to qualify for through a pyramid exam. It's just the fact they bring their money out from wherever they have it, under the mattress, out of the CD. We're going to accept it, and then based on their age, we're going to dictate the actual product availability to them. But again, no underwriting. So take advantage of that. Bring us an application for that annuity in the next 30 days. It'll get issued rapid fire. Believe me, they do. And we'll add an additional $100 incentive to the commission that you'll earn on that particular product. Only on one. So I know they'll probably have a couple out there for husband and wife who'll both want one of these, but we're only going to give you one bonus for the two you bring in, and for the third and fourth that you get from the neighbor or friend, again, just that one bonus to begin with. Questions? Basically, we only had one question. I don't know if you could see it on your screen, Chad, and it was from Paul. He was interested in knowing about annuities that primarily are single premium products, which again, that is correct, Paul. That's what we dealt with today. But just for your information, Paul, there are other annuity products that have the flexibility to add additional premium dollars with time. With all that in mind, I don't see that we have anything else that we can address this morning. Chad, again, thank you very much, and again for bringing it to us in such a fashion that I think the agents should have a better handle and be more comfortable going forward.
Good deal. Well, I appreciate it, Mark. Thank you again.
All right, ladies and gentlemen, thank you all. Signing off. We'll see you next Wednesday, same time, same station. Mark Hunter at Messer Financial. Thank you.